So this webinar today is powered by Aave, Centrifuge, and ConsenSys. The plan for today is to have a quick introduction to set up the scene for the following conversation with Johan Bormann, who is like head of product at MetaMask Institutional. His presentation will be super data driven and will be super complementary with the panel conversation we'll have right after. And the panel is going to be led by Daniel Roberts, Dan from Decrypt, editor-in-chief. We'll basically set up of course, lead the conversation with Ajit, head of institutional business at Aave, Didier, CTO of Codify at ConsenSys, and Jason, chief commercial officer at Centrifuge. So thank you so much all for joining us. And if I can, let me just check if Johan is here. So this is the agenda. You're all good. And I will check if Johan is here. So yeah, I apologize. It seems that Johan just have like a small logistic problem. Let me just check in 30 seconds. Hi, Johan. I can see you here. You can turn on your camera.
Amazing. All right.
Hey.
So I think we got there in the end, although
yes.
At the moment, I think I am a member of the audience. I don't think I can share my screen. I don't think I've got access rights.
Okay, I will do it. And meanwhile, let me check. You should have all the right. I don't know why it's not working, but what I can do, Johan, if you're okay with that, is that I can share the screen.
Let's do it
for you.
live.
Yeah, the bad thing is that we are not going to see your face. I'm sorry for that. But hopefully your voice will do all the job.
Some might say that's a blessing.
Okay, let me do it now. And again, thank you so much for all the attendees who are joining. This is amazing to see all of you here. Okay, here you are. This is for you.
Fantastic. Excellent. So let me jump in. Apologies for the technical errors, everyone. What can we say? Sod's law. So normally I have a very easy job because we have a fantastic panel today. And so I probably don't have to say too many interesting things, but I really wanted to give reverence to these panelists today. And so what I wanted to spend time doing was essentially just talk through some of the learnings and a lot of the data that we have seen within our conversations the last 3 months. Having spoken to, I think, over 100 crypto funds, hedge funds, banks, prime brokers, OTC desks, as well as long-only managers. And what I want to share with you is really sort of, why this is a really important time within the institutional world. So over the introduction, my name is Johan Bormann. I am the product manager for MetaMask Institutional. My background is in finance. I was a portfolio manager and then joined the robo-advisor as director of product before building my own fintech business. And I joined ConsenSys at the start of this year to be the product manager for MetaMask Institutional. Next slide, please, Dunia. Okay, so these are things I want to talk to you about today. The importance of DeFi, adoption cycles specifically within the institutional space, very importantly, user needs, and then lastly, institutional access. So I think, it's really important to always start from first principles. And there's so many definitions of, why DeFi is really important and the role that it's playing within the institutional world. But I wanted to use this quote because it's not only one of my favorites, but I actually think that it's a beautiful summary of DeFi. And what we've seen for those of us who come from a financial background or fintech background is that we know that innovation is very constrained within these markets because there's not a lot of freedom. And next slide, please. And what we're seeing within the DeFi space essentially is radical innovation, radical freedom, and a rethinking of the entire financial infrastructure from first principles. And it really doesn't matter if you're thinking about primitives like brokerage or asset management or payments. All these categories are being rebuilt within the DeFi ecosystem, but they're being rebuilt to be interoperable, transparent, and more secure. Next slide, please. And so there's different ways to kind of map growth in this ecosystem. I think this is one of my favorite slides. It looks at network activity in 2019. And if you go to the next page, we basically have seen a Cambrian explosion in a matter of 1 year. Next slide, please, Dunio. And it really doesn't matter if you're looking at a variety of different measures, whether it's total value locked or decentralized growth, exchange growth. Next slide, please. Or obviously lending protocol growth. Next one. What you've essentially seen is obviously, radical growth, radical innovation, and also going along with that, radical returns. And you've seen a very particular user persona step into this market to take advantage of these returns. Next slide. Okay, so we talked about radical growth, we talked about radical innovation. What are we seeing in terms of user personas? And there are different ways to map this market. This is just a little mental model we have internally, looking through, I'd say, 3 broad categories within the institutional space. And what you've seen is essentially regulation playing a role in terms of the direct stepping into DeFi as well as access to DeFi. And so you've seen early adoption within the institutional investment space, very much focused on chasing these high returns. Next slide, please. Within the institutional investor space, you can also have a segmentation between sort of small and mid-cap funds. And it's this market segment that you've seen the earliest adoption within. And we're now getting to a stage where we're seeing larger, more regulated institutions, both crypto funds with more than $1 billion in AUM, but also very importantly, more regulated hedge funds trying to figure out the space for the first time. So for example, thinking through compliance, thinking through custody. Over to the next slide. And I think we're in a very exciting time within the institutional world. We're very much at that crossing of the chasm time where we're seeing more regulated entities, whether they be banks or hedge funds, trying to figure out the infrastructure layer within DeFi. And so again, very apt for the discussion we're having today. Next slide, please. Okay, so perfect. So we've talked about adoption cycles. And when I think about adoption cycles and users, that obviously translates into user needs. And there's various different ways to kind of map user needs. This is one of my favorites, a mental model I have, thinking through the entire transaction flow process. So how do institutions think about research and analysis? How do they do pre-trade compliance, execution, monitoring, reporting, and of course, custody? But this kind of vertical allocation stack, if you take to the next slide, can very much be thought of as really kind of a pyramid. And this is really important because the bottom half of the pyramid are all the things that are regulatory requirements. And to think about why this is important, and a good example is that if you look at essentially the institutional space within the US, if you have more than 150 million AUM, it basically means that you are required to have a custodian. And what you're seeing right now is an explosion in all these categories of different products and services building for the institutional space. And I think the most exciting thing, which is very apt for the conversation today, is this idea that we're seeing very much a building of the infrastructure layer within DeFi. And that's the layer that's needed in order for DeFi to cross the chasm into the CeFi world. Over to the next slide, please. And so essentially what we're seeing at the moment is a ton of investment happening within the infrastructure layer. The custodian business in the traditional finance world is quite a boring business to be in. No offense to anyone in the audience. And the crypto space right now is obviously really exciting. We're seeing acquisitions, we're seeing investments, and the same thing is happening obviously within the compliance layer. Next slide, please. And then also very importantly, the execution, final slide. And so what we're essentially seeing is basically tooling being built now, whether it's order management systems, data analytics, order execution systems. We're seeing really kind of the tooling of prime brokers, OTC desks, and market makers. And an interesting thing to think about, next slide, yeah, is really, what does institutional access look like? And this is perhaps something the panel can discuss and debate. You know, are we heading to a world where crypto assets are going to be executed and bought in the institutional world through prime brokers, through centralized exchanges, through OTC desks? Or are we heading to a world where DeFi will play a larger and larger role? And I think to add to that conversation, we, no doubt we'll see this Cambrian explosion continue. We're going to be seeing layer 2s later this year. We're seeing side chains. We're heading to a multiverse world. And so the side universe, I think, is going to become more and more important. And I think, go to the next slide. If you think about, access to DeFi today, it very much is driven by, MetaMask essentially. And of course, there are tons of wallets that exist in the space today, but really Aaron Davis and Dan Finley and Jacob Cantel and really the entire team at MetaMask deserve so much credit for innovating in the space, essentially being the DeFi bridge, today. And the interesting thing to be thinking about as we continue through this space, as we think about institutional access to DeFi, next slide, what we're still seeing in a lot of our conversations is just how painful it is for institutions to get access to DeFi. This is literally a mapping of 2 conversations I had with crypto funds, where they're moving assets from cold custodian storage, they're moving it into a hot wallet, they're potentially using a Gnosis safe so they can have multi-sig and risk management, they're scanning QR codes, they're connecting MetaMask wallets, a really inefficient process, multiple steps, multiple transactions and gas fees. And this is something, we within the MetaMask institutional team are really focused on. How do we think about institutional access within DeFi? Next slide. And so what that essentially means is, like, how can we provide unrivaled institutional access? And then the next slide, please, but also ensure that we provide risk management for institutions. So thinking through things like custodian integrations, the safe storing of private keys, multi-sig compliance. These are things we're like hyper focused on right now. So final slide, please, Dunia. So just to conclude, we talked about the importance of DeFi, we talked about adoption cycles, we talked about user needs, and then very importantly, what does institutional access to DeFi look like? I'll apologize again for the technical errors. What I will say is that if you want to get in touch, please get in touch with us via the MetaMask institutional landing page. I've also put up my email address, which might be a dangerous thing, but yeah, please do say hello. And I'll hand over to the fantastic panel.
All right, great stuff. Thanks, Johan. And thanks everyone for being here. It's a perfect segue to what I wanted to start with. And just by way of reintroduction, I'm Dan Roberts. I'm the editor-in-chief of Decrypt. I hope everyone who tuned in for this knows our site, reads us, gets your news from us. We got 3 great brains on this call here. And I just thought a great place to start when we talk about DeFi. I mean, anyone who's watching this probably knows all the terms. It's funny, you guys, usually when I do live events and panels, I like to kind of step back at first and start with basics or 101, but I have a feeling everyone watching this webinar already knows kind of the players here. So it's funny, I mean, Johan said something that stood out to me, and it was exactly what I wanted to start with, which is that we're in the process of DeFi kind of crossing the chasm, right? And also mentioning the fact that it's painful right now. I mean, as someone who's covered this space since 2011, I certainly see that. I mean, it's still early days. I tell everyone it's still so early. I mean, DeFi is still, itself so new. Even crypto in general, 11 years, still pretty new in the big scheme of things. And so there's so many institutions, call them TradFi, call it Wall Street, whatever you want to say, that they just kind of can't get there yet, right? And I imagine that the usefulness of having you 3 on the call here is, what are the conversations you're having with institutions? I mean, what are their concerns, their hesitations? What I always tell people is there's still a lot of friction when it comes to DeFi. I mean, I think it's still one space where a lot of the people who are, knee deep in this stuff and they know all the terms and they're down the rabbit hole, they're crypto savvy. It's still a space that I think has a lot of barriers to entry for newcomers and for traditional institutions. And Jason, I saw that just recently, that was something Centrifuge was trying to address, is trying to reduce that friction, bring on institutions, hold their hand a little bit, make it more mainstream. Talk to us and talk to everyone a little bit about that process, because to me, there's still a lot of friction to be reduced if you guys are going to onboard more traditional financial institutions to this space.
Okay, sure. Thanks, Dan. So Centrifuge is a company that bridges real-world assets to DeFi. That's our kind of position, our DeFi money Lego, you could say, bridging real-world assets to DeFi. We are composable with other DeFi protocols as well. The most I guess widely known one is our integration with MakerDAO. So I think of it kind of like Centrifuge is on the sell side and MakerDAO is on the buy side. And we work with real world assets, typically asset originators, whether they are lending companies or invoice companies or royalty companies, someone that's kind of constantly originating new assets, right? And we work with them. I spend time with those asset originators to tokenize each individual asset, put them into a pool, structure that pool, kind of add a layer of credit structuring to it, where there's a senior and a junior tranche and a variety of credit enhancements to that pool. And then I bring it to market. And typically the asset originator will take the junior tranche, and the senior tranche will be sold to either investors or bridged to other DeFi protocols like Maker. So the asset becomes a collateral asset that can be added to a Maker vault in exchange for DAI, for instance. So the example that we did in May was a real estate company where we bridged their assets to MakerDAO. So when institutional investors come to us, they are really interested in this process. And I spend a ton of time with them figuring out how they can become an issuer, basically. Somebody that purchases assets from the asset originator and then effectively acts as a sophisticated wallet. Like the stuff that Johan's building with MetaMask is perfect. Like we're definitely gonna have to have more discussions about now that MetaMask is going to the institutional market. But we're basically acting as a wallet to help them kind of bridge their assets, tokenize them, structure them, and then bring them out to market. That's what an issuer can do on our protocol. And then another kind of vector point into Centrifuge is they can become an underwriter as well. They can look at the assets and they can put skin in the game by investing in the junior tranche and basically doing the credit analysis and underwriting in order to validate the pool. So they kind of act as like an insurance buffer for any of the senior investors that come into the pool. So those are the two spaces where we talk to institutions a lot, as an issuer and as an underwriter.
And I mean, Didier, Ajit, feel free to jump in. I mean, what I'd push you guys on is there's such a learning curve here, right? I mean, when you're talking to these companies that want to get into this space, I always feel like there's still an educating that has to happen. I mean, what are the questions you're hearing? What are the fears and concerns these companies have? I mean, what I've always said for years, even just with crypto writ large, is kind of the minute you take away the banks and the minute you take away those certain safeguards that are the very reason a lot of people love this space, there are certain institutions that they just can't go there, kind of, but they're seeing that it's growing. I mean, $80 billion locked up in DeFi protocols, and they're seeing something's happening here, but I imagine there's a lot of heel dragging.
Yeah, I think, no, I haven't seen any heel dragging, right? I think there is when you think about the spectrum of what it means to be a financial institution, then there is a whole spectrum of how regulated an entity is and the full body and complexity of regulations that apply to it, right? So when you think about retail banks are at the far end. They protect or grandma's money. There's a huge amount of regulations that apply to them. And there is, but then on the other end of the spectrum, you have crypto funds, which are often, a small number of people in a corporate structure, and everything in between, right? So hedge funds, family offices, there is proprietary money, and then there is client money. So client money is generally more regulated than proprietary money. And when we think of regulation in crypto, then a lot of people tend to think just about, KYC, transaction monitoring, suspicious activity reporting and things like that. But then there is a whole other body of, prudential regulation, which involves capital reserves, things like that. And then there is a whole other body of regulation around consumer protection, data privacy, and so on and so forth, right? So as we go from the left to right on this spectrum, the threshold that an institution has to cross to do anything new, right? And if you look at retail banks, then they've taken 10 years to develop mobile apps, and they still can't get it right. So because of how the post-crisis regulation has really crippled financial institutions, it takes a long time in a traditional institution to innovate. So it's not that institutions are dragging their heels, it's just that there are substantial barriers to innovation in banking today, right? And that's why the cost to income ratios of banks are so high. That's why banks are generally unprofitable in Europe and things like that. It's not that people don't want to innovate. It's just that we have created an environment and infrastructure where it's really, really difficult for institutions to innovate. But when it comes to participation in DeFi, right, there are quite a few hedge funds that are already very active in DeFi, right? And the only way I know is because I get a lot of inbound messages on LinkedIn. Then we spend a lot of time, answering questions and educating on what this works. There is also a lot of terminology in DeFi that doesn't help, right? Because there is this whole degen terminology that's kind of evolved over a period of the time. And then sometimes, when you're dealing with institutions, you have to simplify and translate it. Yeah, you have to answer a bunch of questions around, all of the different regulations that might apply or may not apply. Now, in terms of, hedge funds or family offices engaging with proprietary money in an OTC marketplace, with whether it's a liquidity protocol or an automated market maker, there aren't any barriers, right? There aren't many barriers when it comes to, and that's why a lot of the proprietary money is already in DeFi, right? So now it's a very small fraction of what's possible. But it's not so much a matter of heel dragging. There's definitely work to be done on education. There's work to be done on, we'll talk about more regulation and legal aspects a little bit later, but there isn't a heel dragging. It's more speaking to the opportunity, and then, just information, education, just being available to answer questions and support. That's really worked for us at Aave.
Yeah, so I totally agree with Ajit that you have to segment that space. That they have different problems and different opportunities on different side of that space. I think clearly for funds, they are definitely interested in jumping in. There's, as Ajit says, there's a lot of education. There are compliance risks, security risks that they have to factor in. There's just the complexity of the space and the number of opportunities, and how do you know which ones are the good ones and which ones are not the good ones? Again, that's education, but that was also research that, like Johan mentioned, and dashboards and like ability to understand where are the opportunities. For traditional financial institution, I mean, for sure, the pressure of regulation limits their ability to innovate. At the same time, I would say the following is that, because of those constraints, it's tempting for all financial institutions to take things step by step from the start. So from business process automation to tokenization to, then only then considering maybe issuing a stable coin or, delivery versus payment of asset versus the coin, and then eventually get to programmability. And it makes sense, right? Because it's a reflection of the hoops that they have to go through from a regulatory perspective to actually get to that point. And that's, for some institutions that are ahead of the game, it's already incredible what they are, how far they manage to go considering the constraints, right? But at the same time, if we really want to bridge traditional finance and DeFi, and if those institutions want to make the most of the opportunities that might exist in DeFi eventually, both in terms of automation and efficiency, but also reduction of risk in some respects, or reducing counterparty risk, creating new financial products and new structured products. I think it's very important for them to innovate from both sides, from both ends of that spectrum, go through the hoops on one side as they have to, and at the same time take the opportunity to experiment with some of those protocols. So when Aave releases private pools, well, maybe that's something that is usable in a pilot by a bank to experiment and understand some of those opportunities. And I think in investing, so innovating from both hands is very important, I think.
Yeah, and it's funny. I mean, you talk about trying to know which ones you can even trust. The space is so new, as I said. I mean, even Aave, you guys launched, your own token, October 2020. So it's been less than a year, right, Ajit?
No. So Aave has been around 4 years, right? It's one of the, the earliest DeFi protocols in the space. There was a transition from, the Lend token to the Aave token, but the token has been around a while. So over a period of time, by continuously innovating and essentially building a very secure and robust protocol, and not testing in prod, but testing thoroughly before you go into prod multiple times, and getting a lot of security and audit and stress testing done. I think Stanley, Jordan, and the entire Aave team, we have earned a lot of trust. And I think we're also trying to shift the culture in the direction where people do a lot of testing and sort of have a sense of even as software engineers, right? We don't operate a financial service. We are software builders. But the sense of responsibility and really, kind of recognizing what's at stake for users, and that sort of cultural shift is also quite useful in sort of bringing wider consumer and institutional engagement into DeFi, right? So we're trying to shift that with practices and culture as well.
Yeah, I mean, you mentioned establishing trust, and I want to tell the audience too that we are going to make time eventually for questions. We're already seeing some good questions in the chat, so I'm monitoring those. But what would you guys say to a traditional family office, non-crypto? Because it's one thing for crypto firms. Of course, crypto firms are embracing this, getting into this. But what would be your first step 101 to a traditional family office that okay, we're eyeing DeFi, we want to get in, but their understanding level is at a 0 or barely a 1. I mean, one of you mentioned experimentation. I say the same thing to journalists too. You got to play with this stuff and try it out if you're going to write about it intelligently. But what would you say is the first or first 2 steps? I'd ask each of you to kind of get comfortable with this stuff before they're investing clients' money.
I think it's test themselves as individuals, almost I would say that's the first step. And actually some people already do it, right? You have people who work in banks or in funds that are already using DeFi in the personal capacity. And that's the best way to start and understand, what's going on. Then whether you can invest at scale with client money is a different topic, and it requires different infrastructure. You need to make sure that you have obviously assets well managed and well protected. So the right understanding of the compliance aspects of things. And there are more and more companies that are offering content day to day. So whether in terms of market research or explaining the protocol, explaining the value of the governance tokens, giving more clarity to people as to what drives the value of some of those tokens. So I think there are now more and more sources. It's true that it's still complex. There's a lot of things going on. So the best is to focus on the key, largest protocol and understand them, start there and invest wisely and take it from there.
Yes, so I think there is that journey makes sense, right? It's and we've seen this multiple times now that and people are incredibly smart in financial services, right? They're really intelligent people. So all the family offices, hedge funds that I've had to do support inbound, they're incredibly smart people. They figure out the opportunities really quickly. So there is a path to going from MetaMask and custodial wallets into Bitcoin and into Ethereum. And from then on, the DeFi journey is incredibly straightforward, right? So building Rails has been a key focus for us, enabling access through custodians to governance, enabling access through custodians to the entire Aave functionality as much as possible. Then also through as many wallets as possible. Then the fiat to stablecoin rails, because a lot of DeFi depends on stablecoins and wallets. So once we spent a lot of time building all of these rails, and once the rails are set up, then it's a matter of pointing users and entities to, hey, here is a video by DeFi Dad, go look at it, or what wallet are you using, which custodians do you already work with, and here is someone you can work with to go from fiat to stablecoins or fiat to crypto. So I think a lot of what we do in terms of we don't do any sales. Right. So, and that's a statement I'll make very clearly. So we don't do any sales. We never had to do any sales. The brand is incredibly powerful. What we do a lot is sort of education, support, explaining, walking people through, doing a bunch of demos and things like that. So that's the kind of work in creating a lot of trust as well.
When we work with family offices and institutions, most of them are typically regulated entities or they want to be regulated, and they're trying to do everything totally above board. They don't want to do anything that could damage their overall business from a regulatory perspective. So they tread lightly when they come to crypto, and they're interested in following all the rules and making sure that they're not triggering anything that would send a regulator or securities person to their way. That's number one. So the things we typically do is we suggest creating a separate LLC. The LLC gets its own tax ID number. From there, they typically capitalize that LLC with some money, so it's kind of bankruptcy remote and kind of ring fenced from everything else that they're doing. Now they have this entity that can go participate in the DeFi world. For instance, in our case, we'll say, okay, go buy some assets, go buy some real estate, or go buy some invoices or royalties or whatever. Go buy them. Now the LLC owns that. Now let's tokenize that, tokenize those assets, typically in the form of NFTs. Pool them, tranche them, and issue them to the market. So they now issue tokens of their LLC that they've created to the market, and others can buy those tokens that represent the underlying assets in the pool. It's remote from their entity. It's done through a Reg D or Reg S private placement. Everything's KYC AML'd. All US investors go through an accreditation process. So from a regulatory perspective, they feel comfortable. We're following all the rules that are in place in the US. We're allowing both US and non-US investors to enter into the pool, and we are selling tokens to those investors. And the stuff that we've developed with Maker has allowed us to be composable with other protocols that can work within this kind of regulatory framework. And I think the stuff that Ajit's doing with Aave, I'm really excited about the permissioned pools. I need to learn more about it, but it seems like it could be a very interesting way to integrate with Aave and others. So I feel like regulated DeFi is kind of creeping up and kind of sneaking in. And I think the institutions and the family offices will really like that.
See, what's interesting there is, I was in Miami for the Bitcoin conference. I know Ajit was there as well. I don't know how many of you, the rest of you were there, but there was a funny t-shirt among many funny t-shirts that said, KYC AML is the illicit activity. And I mean, there is an obvious push and pull, philosophically still, I think, between the people, the institutions that have rushed in because they like the investment opportunities and they're welcoming regulation. They're saying, bring on regulation, regulate us. And they want to do it all above book. And then the people who the very thing that drew them to this space in the first place years ago was, it's not regulated, it's outside government control. I mean, are you guys seeing the tension with that? I mean, Ajit, with Aave, I can sort of guess what side you fall on, but are you hearing concerns around that?
Yeah, so we get a lot of strong opinions on Twitter, and as Didi and I were talking about some time back about whether there should ever be permission DeFi and things like that. Right now, so at Aave, at least our philosophy and I think Stani and Jordan's vision has always been to enable access to everyone, right? And that means everyone. So we launched the Polygon market because the gas fees were really high, and we were the first major DeFi protocol to do it. And that's brought in everyone onto Polygon, and it's just brought a huge amount of users. So sometimes you kind of have to take a bold decision and really move the needle in the right direction. Now, so I think the point about KYC is a broader point, right? So we have created an infrastructure of regulation that's currently run by audit firms, lots and lots of lawyers, and tons of manual processes, right? And a lot of people make a lot of money out of that, but who loses as a result of all of that cost of compliance is the average consumer. We have logged billions out of credit by creating a system of regulation. Every time some rule, we create new rules, and every time a bank breaks that rule, I mean, whether it's HSBC's AML issues or whatever, we just create new rules, and nothing really changes, right? So with DeFi, I think the approach is that we create transparent, automated infrastructure. Which enables permissionless innovation, doesn't lock people out of, anyone can contribute to Aave through the grants DAO and so on. And that permissionless innovation is really powerful because it's meritocratic, brings a lot of people into work, enables just, you don't have to get a job, go to Harvard and get a job at Goldman to contribute to Aave or the rest of DeFi. So that's really powerful. Now, so the goal is, there is an egalitarian goal here, which is kind of the core to DeFi, which is, how do we sort of achieve the principles and objectives of modern regulation without the costs and, the burden, complexity, inefficiencies that's locking billions out of credit, right? I mean, a lot of people just don't have access to bank accounts. They don't have access to credit. So, I mean, so the people who modern regulation is designed to protect are actually getting killed by it, right? I mean, they're just being locked out of opportunities and the future. So DeFi is sort of, every time we speak to regulators, and I was, we were with the Bank of England last week, And we have spoken to just about every major regulator, FCA, SEC, you name it. And I mean, so there has been a lot of alignment with policymakers and regulators on what we are trying to achieve, right? Now, the question is, how do we get there? And it takes a certain amount of time to sort of communicate the message that, you know, the goals are the same, but what we're trying to do is, you know, we have to probably start from the beginning and focus on principles and objectives, and not so much the formalisms that, you know, cost European banks 60-70% cost to income with zero return for the user, right? So I think so shifting the conversation and not making it adversarial, right? Saying, oh, we are against regulation, then no KYC, that doesn't help. I think the question is, you know, where are we trying to get to? And I think regulators are aligned on the objectives, right? The question is, how do we get there together? And once you shift the conversation in that direction, you make a lot of progress, as opposed to, oh, no, you know, let's change everything immediately. I mean, that doesn't work.
Didier, do you see a push and pull with kind of regulation and the extent to which, you know, people are either concerned, not concerned, trying to proactively talk to the regulators, hold their hands?
Yeah, so it's a natural for, you know, regulators to focus on risk and not the opportunity. So it takes time to shift the conversation from, you know, just, oh, there are risks. I mean, there are risks in you know, we had 5 banks, investment banks, lose over what? I mean, within the Archegos incident. Is CeFi not risky? It's insanely risky. Regulators worry about it all the time. If you look at SEC's priority list, you know, crypto is not on it because we have much bigger problems to deal with in, you know, in stock markets, bond markets, commodities, and so on. So there is, I think when you think about, when you have it's important to have the right conversation with policymakers and regulators, and sort of try to have a sense of empathy for what everyone is trying to achieve, right? And when you sort of take that tone and that sort of thoughtful approach to regulation and to institutional, you know, and consumer money and asset protection, then you sort of take the conversation a lot further forward than just, you know, talking about revolution without thinking about why we are doing what we're doing.
Yeah,
I would just.
Yeah, no, I think it's very important. There are a few important points in what Ajit says. Is the fact that we obviously don't want the existing regulation to be applied in a similar way to an industry that is meant to be completely transforming, or a technology that is meant to be completely transforming the industry and replace the infrastructure by something different. So the fact that DeFi is open and permissionless, and the inclusiveness of it is a positive. You can also see it as a risk from the perspective that as a consumer, I can put my assets into any of those protocols and lose money because of, you know, smart contract issue or a market move or whatever it is. But that's seeing the negative. The positive is that it's available to everybody with a minimal degree of intermediation and at a cost that is a fraction of what it is in the traditional systems. So I think what's important in that discussion with the regulator is make the case of a risk-based approach to all of this that is not like, you know, a big hammer that hits the system and basically destroy the opportunity of more inclusiveness. And I'm sure, and people are smart, they understand the two sides of that equation, and the fact that regulation needs to tread somewhere in the middle to leverage the opportunity and at the same time, you know, protect consumer against the worst side of it or the most risky side of it.
Yeah, I was just going to add that a PPM and a subscription document is basically just a set of rules between an investor and a fund manager. Those rules currently are signed and then they settle in a certain jurisdiction. It's all done through kind of legal infrastructure. There's terms on how you'll work out disagreements if there are any disagreements. It's all set right there in stone in that subscription agreement. There's no reason why every one of those terms can't be turned into a smart contract and enforced on chain. And then you still have the settlement issue, which settles in a certain jurisdiction. That could still remain. Perhaps someday there won't be a need for settlement because all rules are followed by the smart contracts and you can't do anything other than what the smart contracts dictate. But it's kind of interesting to see where that goes. And there's a couple states already in the US where smart contracts are law. Like you can move to smart contracts, but the problem there is that there's no there's no what's it called? What's the word? I'm losing track of the word, but there's no precedence. There's no precedence. There's never been a case that actually has brought this to court. So even though it's been approved by the state, you can't point to any case saying, well, this is what actually happens when you come up with that type of disagreement. So it'll be interesting to see how that moves. I think more and more rules will move into smart contracts, and then we'll try and settle more and more on chain as time goes by. At some point, code will be law, hopefully.
I want to get into some of the great questions we've gotten in the chat, and one of them addresses something I wanted to ask you guys, which is, for now, especially when we talk about the big numbers that tend to get the most attention in DeFi, the main kind of use case has been speculative investing, right? I mean, you can lend and earn big interest that way and get high yield, fine. But I've heard you guys toss out a couple different use cases. One of you, Jason, mentioned real estate, whatever kind of assets you want to mention as an example. I mean, I want to make sure that in the panel, in this webinar, we answer the question of what is it institutions are looking to do? I mean, obviously, there's the very simple case of, gee, make more money for our clients and invest. But what are some of the other use cases that you're hearing from them of, here's something that DeFi either already can be used for or pie in the sky eventually could, become a good use case for that they're eyeing, something maybe beyond just, here's a way to double our money.
So just let me step in, right? It's the job of an asset manager or a financial institution, right? So what makes an institution different from an individual is that it's typically someone else's money, right? So that's what we mean by a financial institution normally. Even if it's a lot of hedge funds now organize themselves as family offices, because of regulatory reasons and so on. But ultimately, the job of an asset manager is to make money for users, and there is nothing wrong with it, right? So when we often refer to words like arbitrage and speculation in a slightly negative way, I think these two words are the foundation of all finance. So let's just not have anything against making money, because that's what institutions do for us, and that's why I'll be able to retire someday. So that's the first thing. Now, making money is good, right? That's what we do in capitalism. The second part is, so institutions, they're looking to generate a return. Now we know that fiat yields are almost zero or negative, right? So Swiss banks are asking customers to go away, as in take their money and take it somewhere else. So in an environment like this, when the yields are nearly zero, and the only option an investor have is to speculate on lumber or and when we say speculation, I mean crypto is unfairly blamed, right? The level of speculation in this monetary environment in stock and bond markets and commodities is at a completely different level. Crypto is completely tame compared to what's going on if you're looking at other markets, right? So now, so the opportunity is to earn a healthy yield in a protocol like Aave, right? So we've, even in a negative interest rate, even in a deleveraged circumstances, we have had 3 to 5% yield on USDC, and that's purely market determined. It's a clearing type of mechanism where yields arise as a result of organic demand and supply for for assets. So it's transparent, it's automated, it's a lot more secure than what a CeFi entity might be doing to make that yield sausage behind four walls, right? So everything is open source, everything is on the web. So there are a lot of the risks that come with lack of transparency in CeFi are not there in Aave, are not there in a lot of DeFi, right? So let's just also think of risk in terms of what risks are we trading off against each other? So what risks does transparency and automation take away from, let's say, CeFi lending, where you really don't know how the yield is coming together, right? So you're taking just a different set of risks. That's the second part. One, it's good to make money. That's what institutions do for us. Two, you're just taking a different set of risks, right, with CeFi versus DeFi. Three, now there is a lot of infrastructure that's come about. So today you can get up to 46 million, up to a 46 million deposit position you can secure on Nexus Mutual today in Aave, right? So there is a lot of work that DeFi is currently doing to reduce risk, both at a technical level. We did so think about CeFi, I'll make it short, but all the major CeFi crypto exchanges were down when Bitcoin crashed 45%. You know what was not down? All of the DeFi majors were not down. So they worked painlessly, right? I mean, we had 135 million worth of liquidations in Aave, but the resilience, and we talked to central banks about this as well, but this is a pretty big deal, right? So you built resilient infrastructure, and it didn't happen by magic. We ran a whole bunch of stress tests with Gauntlet, right? So it's a lot of this is about practices, standards, behaviors in the industry and DeFi is maturing quite rapidly. So, I mean, obviously everyone loves headlines about, oh, this went wrong, that went wrong. But People don't talk about everything that's going right. And this is year 2 of DeFi. Think about where this ends up in 2 decades, right? I mean, Netflix were talking about streaming in 98, but it took until 2010 to really stream. So give us another 10 years and we'll change everything for way better. So I think that's the approach we need to take with policy and regulation, right? So look at what's going right. Look at what the opportunity is. How we are sort of reducing a lot of the existing risks in the system. And where are we going with that? And institutions see this, right? Ray Dalio has talked about it. I mean, a lot of regulators like Hester Pierce and Brian Brooks have talked about it. There are lots of really sensible, forward-looking people in the ecosystem. And it's important to sort of, and especially among financial institutions, right? So I think once you level set and use the right tone and language, I think a lot of things become a lot easier.
I would say, I think the question, Daniel, was what asset classes will investors look at, right? What's coming? So I would say, first of all, that business, legal, and tech are coming together to digitize contracts. So once they're digitizing, once those contracts are digitized, the protocols are basically linking them if this, then that protocols. So one smart contract to the next smart contract all linked together. The DAO is setting the parameters saying, well, this one should be 25% and this one should be 10%. That kind of sets the rules up, right? Smart contracts, protocols, and DAOs work together to set the rules of how all the business process will flow. Once that's done, what's not going to go what's not going to go on chain once gas fees are solved and everything? What's not going to go on chain? This is a better, faster, cheaper, more efficient way of conducting business. So I think everything will eventually get there. Centrifuge, of course, we work specifically on credit assets, direct lending assets, which is just an evolution of the 2008 financial crisis, where banks have kind of pulled back on lending and non-bank lenders have kind of risen. Specifically, tech-driven fintech companies have kind of risen to take their place and have started originating all sorts of assets all over the place. That trend is continuing. We're moving from just fintechs to fintechs that are now fintechs on the blockchain, basically. Just an evolution of that path. That's where we're specifically focused.
Yeah, and I think, so to come back to your question, I think in the short term, for institutions, there are things like staking or investing in some asset management protocol that obviously is attractive today considering the return and the sort of trade-off between security and complexity versus the return you get. But going forward, yeah, indeed, I mean, tokenizing assets, even regulated assets, and getting them into protocols or financial primitives that exist in DeFi is creating a pretty powerful, compelling proposition and a potentially superior infrastructure for funds or even potentially banks in some cases to run business, and with potentially less risk, because you have lots of counterparty risk in the financial system right now, and we've seen that in 2008, and we've seen that over and over again. There are plenty of risks that are sometimes largely hidden or hard to estimate in the system as it is today. And this infrastructure is also about bringing transparency, bringing the means for people to estimate the risk, whether it's credit risk based on track record of previous transactions or other metrics that can be generated from information on chain. So I think there are lots of opportunities, but it will take time for this to unfold, and it needs to be taken step by step. I think it's a shame we didn't have time to talk about this concept of permission pools of Aave, but it's in a way this notion of sandboxes, or it's almost like a sandbox component that institutions can use to potentially start experimenting around that, and that's a good way to start understanding what is the opportunity in the future.
Yeah, so just so we are not inventing new finance for DeFi, apart from flash loans. If you really break finance down as a risk and return combination, then DeFi is not really inventing new finance, right? We're just building infrastructure that's vastly more efficient, transparent, and automated, right? To take a lot of cost and inefficiency and risk out of the system. So institutions recognize this opportunity as much as anyone else. And that's the efficiency that's going to produce, returns that are not currently possible in the financial system, because you're just taking a lot of cost out and risk out of the system, right? So institutions recognize that as much as anyone else, and that's what's bringing them to, and there are really new and cool things, right? There's liquidity mining, there is sort of a bunch of return opportunities that come from shifts in market and the availability of data. And institutions are creating other products, right? So for some institutions, it's a matter of creating a securitized product because they're used to accessing, on top of tokens or on top of, interest-bearing tokens. So there are people working on things like ETFs on top of interest-bearing tokens, and so on and so forth. So there is the creativity on Wall Street has always been phenomenal. And let's not underestimate how smart people are in banking and financial services, and that's what bringing them onto DeFi, right? They're just smart people, and they see the opportunity, they know how to put it to use.
A fun, quick way to end, you guys, but just quickly, I mean, a lot of what we talk about that's happening here, yes, there's what's already happening, but then there's sort of what's pie in the sky possible down the road. Ajit said earlier the Netflix example, and he said, let's check back in 10 years. When we talk about, a large, broad swath of types of institutions embracing DeFi, how long will it take? What is the roadmap there? I mean, where do you expect things to be in 5 to 10 years, especially without getting too in the weeds on it, in the context of there are still those types in crypto who see it as there's Bitcoin over here, and then there's the ETH and DeFi world over there. How do you guys see that playing out?
I mean, it will take time to unfold. I'm not sure we should oppose Bitcoin and DeFi so radically, because in practice there's tons of Bitcoin that are in DeFi right now on Ethereum. So it's not as clear as that. But I think for institutions, the message would be, sure, it's going to take time to unfold and to really completely reshape their business. But at the same time, if they don't get ahead of it and invest from both ends, so, gradually going through the process of tokenizing and bringing those assets on chain, and at the same time taking a look at what's happening already in DeFi and how it can potentially disrupt and change their business is super important. And it will take years, but if you don't get ahead of the curve, the blockbusters and the record companies have learned their lessons as to what disruption looks like, and you need to get ahead of it.
Yeah, also, I think Didier's point on disruption is very, very valid. Now, also the rewards for being early are incredible, right? So I think if for entities that are forward-looking, innovative, and take advantage of the new technology and infrastructure that's being built, I think they will reap extraordinary returns in the process. And people who wait because it's going to take time will have returns that are corresponding to the waiting time. So I think I would appeal to the opportunity side of this. I think so one of the things we have seen is entities getting involved in governance. There's a lot of expertise on Wall Street, right? There's an extraordinary amount of quantitative expertise among hedge funds. So we've had lots of good ideas come through, in terms of risk management, in terms of just overall optimization in the protocol. There's just too much quality contribution that's starting to come in from institutions. And a lot of that expertise will, just take DeFi to the next level. So it's not just that, DeFi exists in isolation and institutions will take advantage of it. I think it's also that there is a lot of expertise amongst institutions that are now coming into DeFi, and that's, it's going to mature. And really, we are when we say 80 billion, and it looks like a big number, but we're talking about 150 trillion in global equities or whatever that number is. So I don't even know what that number is, right? So I think we're now big enough in DeFi to be important and relevant, but we're not too big where everyone has to worry about us. So this is a sweet spot where participation by institutions in an early space where there's a just huge amount of innovation will bring in extraordinary opportunities for institutions and for DeFi, right? So ultimately, we are all in this together. So maybe there's a kumbaya, but I think that the opportunities to innovate for people who want to take certain, want to be forward-looking are extraordinary, and the returns will be corresponding.
And when I look to the future in my crystal ball, I say, okay, once all contracts are digitized and all money is digitized and money kind of flows like water, basically what we'll have is everybody, whether you're a consumer or a business, will have a financial manager that they work with. That financial manager will be an AI bot that's looking out on your behalf for you 24 hours a day, never stops, basically creating a borrower optimization protocol that always is finding the best way to optimize your cash balance. Whether, hey, you have too much money in your bank account and you should move some into some yield account, or hey, you have bills coming up in your checking account and you don't have enough money in there, so let's move some money out of your Aave pool into your checking account so that you can pay that bill that's coming up. Everything will be optimized. Money will flow like water, and we'll always have the best yields possible. And our AI financial advisor will help us do that. I think that's the future in my world. That works for both businesses and consumers.
Great stuff. It's a great way to end on the roadmap and the expected timeline here. It's fun to look into the crystal ball. We'll have to check in maybe in 6 months, in a year, in 2 years, and track exactly how mainstream we get and how much how much saturation we get with some of those more hesitant type firms. Really good stuff. Thanks, you guys.
Thank you so much, Dan. Thank you all.
It's been great. If you have any questions, please send them to us, and feel happy to answer questions offline and afterwards as well.
Awesome.
Thank you. Brilliant conversation. And we will definitely follow up tomorrow with, of course, the recording, the presentation, and looking forward even to receive Daniel, if you have like any piece you have been writing that could help our audience, please feel free to send it to me, and I will be happy to add them to the email tomorrow.
We do. I will do that. We have a lot of great resources in our Learn section at Decrypt. Thanks, guys.
Amazing.
Thank you so much.
Thank you so much. Thank you so much. Ciao, ciao.
Bye-bye.